Well, good afternoon. My name is Frank Wolak. I'm the president and CEO of the Fuel Cell and Hydrogen Energy Association. We are the industry trade association for hydrogen in the United States, based in Washington, D.C., representing all facets of the industry and a broad cross-section of participants, all looking to advance the production, distribution, and use of hydrogen. I want to welcome you to this afternoon's webinar, Unlocking Master Limited Partnerships. Master limited partnerships are a financial, tax, and legal structure that have been used for decades in oil and gas infrastructure, natural resources, and real estate. And as a result of FCHEA initiative and support from Congress, specifically Senators Moran and Coons, hydrogen was added to the activities that could access MLPs during the OBBBA last July. Because this is such a new area to our industry and can be valuable to those considering investments or projects, we very early felt visibility of the subject was going to be necessary, and we began talking with the Energy Infrastructure Council and Baker Botts about how we would put together a forum to get that visibility. And so the result of those deliberations and considerations over the summer has yielded this. And to that end, I am really pleased to offer a panel of experts who are going to walk through all the details of this for the next hour or so. Laurie Ziebart, Chris LaGrone, Marc Silverberg, Barbara DeMarney, and Mike Bresson will each take you through elements of their specialty areas, looking to provide as much value as they can in the hour. So I really welcome everybody again, and hope you all pay attention. I will make one other comment, that we understand that there's a nationwide Verizon outage. So for those who would be trying to access this via phone, the materials will be made available. So you're not gonna miss anything. And with that, I'd like to turn it over to Laurie Ziebart from the Energy Infrastructure Council to open up the rest of the session. Laurie, it's all yours.
Thanks, Frank and Connor, for hosting us today and giving us a chance to discuss MLPs and the opportunities they may offer for hydrogen. As you see before you, we have a pretty jam-packed agenda, and we'll try and move through the material as quickly as possible. As Frank said, if there is no time for questions at the end of the webcast, we'll be sure to answer those questions. So please type them in, and we'll get to them shortly after the webinar. Next slide. As Frank mentioned, we have several speakers today, EIC members and also counsel to FCHEA. So we'll just move quickly to the next slide and get started. As Frank mentioned, I'm Laurie Ziebart, and I'm the president and CEO of the Energy Infrastructure Council. We are a DC-based trade association that represents and advocates for energy infrastructure companies across the value chain. Importantly, we are the only association that represents master limited partnerships. Our focus is on tax, SEC-related matters, and sustainability issues. Our membership spans operators and the broader ecosystem, including institutional and retail investors, global and regional banks, asset managers, sell-side analysts, private equity, and legal and accounting firms. Next slide. So why are we talking about MLPs now? A major legislative change through the enactment of the One Big Beautiful Bill Act opened the door for energy transition technologies, including hydrogen, to potentially use the MLP structure. Historically, energy MLPs were largely tied to oil and natural gas infrastructure and certain natural resource activities. Expansion of the structure was championed by EIC with the goal of positioning MLPs as a platform for financing and building energy transition infrastructure. Next slide. So, what is an MLP and why does it matter? MLPs have been around for decades. The first went public in 1981, yet the modern framework largely stems from the Revenue Act of 1987, which narrowed qualifying activities. Most MLPs today are midstream. Think pipelines, storage, processing, LNG. They are long-lived, capital-intensive assets with stable, fee-based cash flows and a high payout profile. The MLP structure has been extremely effective in allowing companies to raise lower cost capital from the public markets to fund large critical energy infrastructure projects. For example, from 2008 to 2023, MLPs and midstream companies raised about $750 billion in debt and equity funding, much of the infrastructure behind the shale revolution. Now I'd like to turn it over to Barbara, who will, with Baker and Botts, who will talk a little bit more about what is an MLP. Barbara?
Thanks, Laurie. Um, MLPs, the phrase master limited partnership is really a nickname that was given to these entities because in the early days, many of them were formed by rolling up and putting together a number of multiple partnerships. But the more technically correct phrase would be publicly traded partnership. And what you may say, well, what is it about public trading that is special? Why is publicly traded important when you're putting the words publicly traded in front of partnership? And that's because there is a general overarching rule here in the tax law that provides that if you are a publicly traded entity, you must pay corporate tax, entity level tax. You must be treated as a corporation for tax purposes. And when we're saying corporate level tax, we're also saying really two levels of tax because the corporation pays tax at the entity level. And then when its profits are distributed, those as in the form of dividends to the shareholders pay tax on those dividends. So we have had this general rule that if you're publicly traded, you're going to pay corporate tax, you're going to pay two levels of tax. What happened was in the act in 1987 that Laurie referred to, a special exception was made for entities that are partnerships or LLCs, entities that are not organized as corporations, but other types of entities. For those entities, they can be publicly traded and they will not be taxed as corporations if they meet certain requirements regarding the nature of their income, regarding the nature of the business that they're conducting. So certain types of businesses could be conducted in partnership form and be publicly traded, combining the best of both flow-through taxation and public trading access to capital markets. So the benefit of that is that that you get a opportunity to access the capital markets without offering a lower tax burden to the enterprise, and therefore potentially and frequently the entities experience a lower cost of capital when they are offering their units to the public. And the lower cost of capital in turn is designed to foster and reduce energy costs, hopefully. So one other note here is that MLPs, because they are flow-through entities and because they're not paying a corporate level tax, they do tend to distribute most of their cash. They distribute out most of their income to the unit holders. They generally don't retain significant amounts of earnings for reinvestment. So you might benefit from getting some picture of what the current landscape of MLPs looks like. And for that, I think on the next slide, Marc Silverberg is going to take us through some illustrations of some existing MLPs.
Great. Thanks, Barbara. Hello, everyone. And just by way of background briefly, so you could contextualize some of the comments I'll make. Appreciate being part of the panel. I'm on here having served for the first 10 years of my career actually as an MLP analyst on Wall Street, where I covered a number of these publicly traded partnerships, and for the last 11 years an advisor to a range of public energy companies from a strategic communications perspective. So that investor and analyst lens is the lens through which I'll be speaking today. I'm not an accountant nor a lawyer. So, I think we wanted to share here some names that you may not have heard of, that really emphasize the scale with which some of these master limited partnerships trade today. And you're looking at three names that we've highlighted: Enterprise Product Partners, Energy Transfer, Plains. You could see here that these are quite literally some of the largest companies in the world, right? They're all within the top 100 of the Fortune 500 companies, market caps in excess of $50-60 billion. And just for context, you should appreciate that FedEx, a name brand that moves packages and logistics all over the country, is a $75 billion market cap company. Target, the retailer, $50 billion, even General Mills, $25 billion. And so hopefully that just contextualizes just how large some of these companies are. And we'll get a bit more into it in a moment, but obviously one of the attributes of MLPs that we spoke about is their the nature with which they pay dividends, or in the case of MLPs, distributions. And you could see that on a yield basis, many of these companies pay on average of 6, 7, 8%. And so relative to the S&P 500 index, which today has a little bit over a 1% dividend yield, you could appreciate why this is such an attractive investment landscape for many of these companies. If you go on the next page, what we've laid out here are the various range of publicly traded partnerships that are listed on U.S. exchanges today. Fun fact, and maybe just going back to what Lori mentioned earlier regarding the 1987 change that really redefined what MLP qualifying income is. The Boston Celtics, the basketball team, believe it or not, was a publicly traded company, and they were an MLP for a period of about 14 years. But one comment I would just make, that why does the MLP structure exist? For a lot of reasons, but at the end of the day, it was created to incentivize the build out of essential infrastructure in this world, in this country. And if you look at where we are today, we are the largest producer of oil and gas in the world. We are the largest exporter of liquid natural gas in this world. That is solely and exclusively, has a lot to do with broader energy industry, but the movement, the processing, the storage of all those molecules that make us the largest producers in the world are all directly related to MLPs. If you turn on your lights, it's powered by natural gas that powers a power plant that probably went through an enterprise pipeline. And so we really just wanted you to appreciate the scale with which these exist. And in the context of this discussion, obviously everyone here is in the related to the hydrogen business. Similar, we're talking about the opening of the structure for mission critical infrastructure that makes the supply chain and the ecosystem of the hydrogen network work. And so the structure, many would argue, certainly all of us would, worked in its ability to make us an energy dominant player in the world. I think now I'm passing it over to Mike on the next slide.
Thanks, Marc. So if a tax lawyer is going to talk, they've got to say a code section, right? So I have to say section 7704. That's the that's the police, that's the gatekeeper that tells you what will go in an MLP and what doesn't fit in an MLP. And the basic requirement is that 90% of the income of the partnership has to be qualifying income, and that means as long as the entity is publicly traded, every year it has to satisfy this 90% of its gross income needs to be qualifying income every year. Otherwise, it turns into a corporation. So people take this requirement very seriously and are good friends with their tax lawyers if they're in this business. The reason that, as Lori and Marc talked about, there's only certain types of industries that have been in the MLP space since the 1987 limitations that kept out theme parks and basketball teams. It's limited to the natural resources space, basically. I'll say the magic words: exploration, development, mining, production, processing, refining, transportation, or marketing of a mineral or natural resource or industrial source carbon dioxide. So that's where you get your upstream companies, pipelines, shipping companies, anyone handling oil, gas, coal, refined products that would be eligible. Timber, fertilizer, and geothermal were specifically called out. So there was a timber MLP for a while. There still is a fertilizer MLP. Interest, dividends, and real property rent also qualify, and there's been MLPs that have leveraged that requirement. And then an addition that I think was made in 2008 was to allow transportation and storage of alternative fuels like biodiesel and ethanol. That let all those terminal operators that were putting ethanol into gasoline be able to actually handle the ethanol. Now, one of the, on that transportation and storage rules, one of the alternative fuels that qualified before the Inflation Reduction Act was liquefied hydrogen, but the Inflation Reduction Act accidentally deleted liquefied hydrogen from the list of products you could transport or store and earn qualifying income. That's the bad news, but then the good news comes on the next slide. Oh, you went backwards. The OBBBA expanded the qualifying income regime once again. One of the additions was that they added transportation or storage of liquefied hydrogen or compressed hydrogen. So not only did we get liquefied hydrogen, which we'd had for years, then we lost it. Now we've got it back again. Plus, we've also got compressed hydrogen. So income from transporting or storing liquefied or compressed hydrogen, qualifying income. Also qualifying income from transportation and storage of sustainable aviation fuel. That's a new category. If you've got sustainable aviation fuel, you know it. It's like it's for planes. It's made from old cooking oil or agricultural waste. It's got some technical requirements, but it also has a tax credit for it. So if you've got sustainable aviation fuel, you know it because you've been working to qualify for the credit, and now it's eligible for to be included in an MLP. The final new addition was some electricity production and sale now qualifies as qualifying income under the qualifying income rule. So you could put a power plant, the right kind of power plant in. If it's nuclear, geothermal, or hydropower, or just kind of conventional natural gas or coal, if you capture at least half the carbon and dispose of it in the kind of 45Q kind of way, secure geological storage, et cetera. So those are our new categories. Hydrogen production has produced qualifying income. The IRS issued a private letter ruling several years ago that hydrogen produced as a byprocess of producing fertilizer, that was qualifying too. Now that might be hard to make work these days because the IRS interpretation has changed a little bit. But I think the bigger issue is that if you think the classic hydrogen production from electrolysis, then that's produced from water. And the only reason that that old ruling thought it worked was because it was a byproduct of producing fertilizer, which was a qualifying product. So there's not much of an argument to be made that producing hydrogen and selling it is going to be able to produce qualifying income for you. And when I say that there's when I talk about arguments, I mean the issue is that you have to be right. If you thought you were generating qualifying income and the IRS comes in years later and says, no, you haven't been generating qualifying income and you owe 8 years of back taxes, that would be catastrophic. And so to deal with that issue, MLPs are very conservative, and anytime they do an equity offering and they get opinions from their tax counsel, they stay close to their tax counsel and make sure that they just don't goof that up. So it's very manageable if you're just stay on top of it. But again, it really is a gatekeeper on what you can have in there. So the bottom line is what came out of all that we wanted to talk about or emphasize today, and we'll talk about it a little bit more later in the presentation, is transportation or storage of hydrogen. That is an MLP financeable line of assets, which raises any number of monetization possibilities that we'll talk about in a bit. And I don't know if I'm turning it over to Marc or Chris.
It gets to
Yes,
me,
next
Mike.
we'll turn it over to Chris. Yeah. Thanks,
All right,
Chris.
thank you, Lori. Thanks, Mike. Pleasure to be with everyone today. Unlike Marc, I am the accountant on the panel today. I spent most of my career working with MLPs through IPOs and servicing them afterwards. So we wanted to take a little bit of time now that we've talked about qualifying income and what MLPs are, their background, and that hydrogen transportation storage now qualify under the MLP rules. It's really an opportunity now to step back and say, well, why would I use an MLP structure at all? What does this actually do for me? What does it do for capital formation throughout the hydrogen infrastructure industry? And I think at a very high level, what we've talked about so far is really that an MLP is this public market yield-oriented vehicle that does give you the opportunity to reduce the cost of capital, especially where you have stable contracted infrastructure revenue. And that's exactly, as we've talked about, what the profile of the historic infrastructure style assets has been, and now obviously open to hydrogen midstream infrastructure style assets, again, that have that stable contracted revenue. When we talk about the lower cost of capital, it's really in comparison to the counterpart of a corporate entity or corporate equity. And so the basic financial reason for structuring it as an MLP is really capital efficiency. As Barbara mentioned, the MLP is not generally paying a corporate level of tax. And so you don't have that stacking of both an entity level tax on top of an investor level tax. And that does translate directly into often a lower required return for the same underlying cash flows, especially since the market is very heavily driven on a yield or distribution basis from the investor expectations, which Marc will talk a little bit more about shortly. As a public vehicle, it does obviously open your access to the public equity and debt markets, which clearly matter when you're trying to fund assets that are large and long-lived capital-intensive projects. For infrastructure, it's critically important, as we've seen it in the past and continue to see it, because that build out tends to be very network-based as you're thinking about pipeline storage and terminals. And you often have that very repeat need for capital over time as you're refreshing that asset or continuing to expand the infrastructure footprint. You're also able to then monetize that stable cash flow. Mike briefly mentioned this, but in the MLP structure, since you do offer a steady contracted cash flow through the transportation storage contracts that often have fairly long-tailed commitments, you are able to monetize these cash flows at valuation frameworks that the MLP market is very familiar with, and generally results in a nice valuation on the offering of those assets. Now, it's not risk-free, but the market does tend to reward that durable cash flow with the distribution-focused investor base. So your access to capital may be quite different than what you would see in a corporate vehicle that you would take public. As I think about the strategic use cases, and so what this means from the hydrogen infrastructure development sponsor perspective, it's really a portfolio strategy tool. MLPs can easily be used as a permanent capital vehicle for the assets that you're currently developing. And what we typically see in the MLP space is a sponsor is actually developing the projects, bringing them to an end service component, and then they drop them into the MLP itself, which accomplishes a couple of things. One, it frees up the sponsor's balance sheet to keep funding those earlier stage projects. But it also, in that drop down, allows you to monetize those assets once they've gone into service through a secondary offering to the public equity markets. And so you're always able to effectively recycle that capital as you continue to move the mature assets into the public entity and use the proceeds to fund the next tranche of growth. And with that background around the entity, Marc, I think we're going back to you to talk about the attractiveness to investors.
Perfect. Thanks, Chris. Yeah, so I'll again with the investor hat on, maybe emphasize some of the points that my fellow panelists hit on with respect to what makes these attractive, this an attractive asset class, and it's exactly that. It's an asset class to public investors. And just for frame of reference, we don't have the stats on here, but roughly 57%, towards the end of last year, roughly 57% of all of the public MLPs were owned by retail investors, right? Those are everyday investors that are investing in their private accounts. And if you think about, well, why is that when most other equity investments have a far lower retail ownership base? It's because the yield component. And again, we hit on the yield-based nature of this asset class, 6, 7, 8% yield versus, again, on average, a touch over 1% for your average S&P equity. And so because of that, it is roughly 60% of the retail of the investor base is retail. Roughly 24% are held by dedicated funds, and there's probably about 12 major investment funds with billions of dollars of assets under management that invest directly in the MLP space. They're MLP only funds, and they really do dominate a lot of the investment ownership. Roughly 10% are generalist institutional investors, and so think Fidelity, Wellington, Capital, et cetera, and the remainder are a range of other things. And so with that as context, why do investors, why are they attracted to MLPs? Well, first is, again, not to belabor the point, but the income. Again, if I'm an owner of Apple stock, which I am, you get a nice dividend, but it's certainly not 6, 7, 8, 9, in some cases, double-digit percentage points. And so if I'm a retiree who's relying on my investments to generate a cash flow stream to fund my retirement, obviously MLPs are highly attractive, and they have been for decades. The second are tax benefits, and again, my more credentialized colleagues hit on the nuances and the sophistication around tax benefits. But the way to think about this is when you receive a distribution every quarter from an MLP, a portion of that distribution is treated as a return of capital. And rather than pay tax on that in the year in which it's received, it actually reduces your cost basis. Technicalities aside, what that means is when you receive that distribution, you're not actually paying tax on a significant portion of it. There is a portion generally that is treated as investment income, just like any other dividend. But again, in your normal course, 100% of your dividend income is treated as income. You're paying taxes in that given year. With MLPs, 75% or greater on average of the distribution is actually treated as a return of capital, reduces your cost basis. What it eventually does is it's delaying and deferring the tax treatment to when you eventually sell these investments, which is a point where if you think about MLPs from an estate perspective, there's actually benefits of passing this on to the next generation, and so you could actually forever defer much of the taxable treatment of the distributions. Fee-based cash flows, we talked a lot about, again, the very specific set of activities and businesses that qualify. The one thing that they have in common is they generate highly predictable fee-based cash flows, highly contracted, 10, 15, 20-year contracts where even though these companies are generally exposed to the energy industry, they're not taking, by and large, commodity price risk. Think of it as a toll bridge is the most commonly mentioned analogy here. It doesn't matter what type of car goes over a bridge, you're paying a toll. The bridge makes money on the volume of traffic. Same thing for a pipeline. There's a certain fee paid for shippers of molecules on that pipeline. It's based on the volume. It has nothing to do whether with crude oil is $70 today versus $50. Naturally speaking, there is some exposure, but investors love the fee-based nature of the cash flows. Diversification, on average over the last, I think 5 to 10 years, MLPs have had a 50% correlation to the S&P 500. And so if investors are looking to diversify relative to the broader market, MLPs do offer a very attractive diversification tool. Again, it is because MLPs are most directly tied to other factors. Does the economy impact them? Of course, in the case of demand, but by and large, it's driven by factors that do offer diversification relative to benchmark indices. Distribution growth. Up until this point, we've talked about the distribution as kind of being a flat fixed rate that we pay 6-7% per quarter. Most MLPs actually grow their distribution every quarter, and I'll leave names out of it, but there were many MLPs over the years that prided themselves on dozens and dozens of consecutive quarters of distribution growth. I actually looked it up this morning. Hess Midstream, which is the midstream arm of Hess, the brand that we all know, 31 times since its April 2017 increased its distribution. And so that growth and distribution obviously is a very attractive component to investors. Liquidity and access, again, MLPs offer a thematic investment in infrastructure build out of essential energy in the country. Hydrogen would be included in that. And so investors love the liquidity and access. Again, $60-70 billion market cap companies. These companies are trading hundreds of millions of dollars per day of daily trading volume. And so that liquidity, while also thematically investing in the energy and power needs of the world and the country, investors love. And income and upside, again, equities do go up. And again, this isn't all about the distributions. And so MLPs, by and large, have performed reasonably well as well. And so it's not just the yield that you're clipping every quarter, the price appreciation of the equities as well. I think now, Barbara, I'm passing it to you on a bit more tax treatment.
Thanks, Marc. Yes, we thought maybe a little more on how an investor in an MLP is treated for tax purposes and how that works. So as I said before, and as everyone has said, these MLPs are not treated as corporations for tax purposes. So they are treated as partnerships, which means that they are what we call a flow-through entity. And that means that all the tax items that are produced by the partnership flow through and flow up to the individual unit holders in the partnership, the individual partners and unit holders. And that means that they get their allocable share of income, of deductions, and of credits. Each different type of tax item comes out to the partners. And that happens mechanically in an administrative fashion. That happens because they get what's referred to as a K-1 every year instead of a 1099, which is what you get, when you get dividend income at the end of the year. A corporation will give you a 1099 dividend, and that 1099 would just have one number on it, but the K-1 that comes out to partners has a bunch of numbers on it. Then the partner has to take all those numbers and roll them into the partner's individual tax return. Marc just gave a very good explanation of the tax treatment of the distributions in that it is highly common, almost universal, that the distributions, the amount that gets distributed is not, if you get a distribution from an MLP of $100 one year, when you get the K1, it's not going to say on the K1 that you had $100 of taxable income. It might say that that your share of the taxable income of the partnership was $25. So you're only paying current tax on that $25, and the other $75 that came out to you is treated as a return of capital to you, which is not currently taxable, but does reduce your cost basis in your unit, so that when you sell, if you paid $100 for your unit, when you go to sell it, the basis in that unit is only going to be $25, and you're going to have $75 of income when you go and sell the MLP. But if you don't sell your interest in the MLP for quite a while, that's a tax deferral. I think that a lot of times some of the less financially savvy unit holders have not appreciated this, and sometimes there have been problems when they've been sort of caught unawares by the fact that, oh gosh, if I sell these, I'm going to have this tax bill associated with it. But that, even so, you've still gotten the benefit of delaying the tax on that cash for however many years up until you've sold. So one other thing that is relevant, especially for hydrogen, is that when a partnership has tax credits, those tax credits will also flow through and be shared by the partners, and they will each get their allocable share of those tax credits. However, there are specific rules regarding the ability of individuals and certain closely held businesses to use tax credits against their own taxable income when they flow through to them from the partnership. There are restrictions that make the tax credits very likely to be unusable by the individual unit holders. And so that's why some people commonly say, well, tax credits aren't valuable to MLPs, can't be used by MLPs. The investors aren't going to value the fact that they're getting tax credits because they won't be able to use them. But the nice thing is that since the enactment of the Inflation Reduction Act in 2022, it's now possible for partnerships and others to monetize those tax credits by either selling them or, in certain cases, getting a refund of cash from the government. And if that happens, what's happening is the partnership has turned those credits into cash, and it can distribute the cash to the partners. And so the credits can be almost as valuable or viewed as valuable to an MLP and a partnership as they would be in other situations, because the partnership can monetize the credits. But it's something to watch for and plan for if federal tax credits like 45V for hydrogen or 48E for hydrogen transportation and storage assets, if those credits are a big part of the plan, the financial plan for the enterprise, they will have to think about monetizing them rather than distributing them out to the unit holders. And then one last note is that there are some sort of sticky issues with holding partnership units for foreign investors and certain tax exempt investors, institutional investors, pension funds, things like that, that make units in MLPs less attractive to foreign investors and pension funds, university funds, things like that. But that just gives you a general sense of the landscape here, a little more detail on this. And so now we're going to go to Chris, who is going to give us more of the detail on the administration and compliance issues that come with MLP form.
Thank you, Barbara. The conversation's been great. The tax impacts of being in an MLP, the access to the markets is all fantastic. And I think it's critical at this point to point out that with all of the upside that the MLP offers, there are real public company responsibilities. So I'm going to switch to what is really the practical side of what it takes to operate and comply as an MLP. This is the part that I think is easy to underestimate, right? We've talked a lot about the tax components of the MLP, specifically that the MLP structure is available because of certain tax law requirements. But the reality is, from both a governance and reporting perspective, this is a public company. And so I think it's important to keep in mind that the MLP will be listed on an exchange, so typically the NYSE or NASDAQ listed issuers. And so you are stepping into a full cadence of public company governance, which includes board expectations, specific policies, your committee oversight, and of course, market scrutiny from that investor base. You're also going to then be subject to, like any public company, your typical SEC reporting and disclosure requirements. So you will have, the 10K, 10Q, 8K disclosure rules. You'll have the audit requirements that come along with public companies, internal controls, control discussions in these public documents, as well as, how all of that impacts your ongoing legal and accounting spend in order to support those requirements as a public entity. I think the key point for management teams here, right, is this: it's not just a tax decision. The benefits from a tax perspective are great in the partnership structure, but this is really an operating model decision and how you're going to interact with the markets going forward. One of the other critical components with any public entity is your investor relations. If you want the public capital, you're going to need to have public company communication. So your earnings, guidance, philosophy, if you're participating in conferences and roadshows, et cetera, strong conversations about your disclosure controls and thinking about those earning calls on a regular cadence. For first-time issuers, so for new companies going into this MLP structure as a public entity, building that IR capacity is often a bigger lift than what you might initially expect. And I would also caveat that with, as an MLP, there is a different relationship with your investors than you might traditionally see in a corporate context. And that's really driven through the way you interact with your investors, especially around their tax information. So as Barbara noted, your investors will receive a K-1 for their investment as opposed to a 1099. And that K-1 is, if you've received them before, obviously is much more detailed, more complex than a typical 1099. There's also not a requirement to have that out by a specified time period in January, for instance. Most of the time, MLP's release of K-1s is governed by a 90-day requirement that are included in their partnership agreements. And so you have to be conscious of how your investors are going to perceive that. Again, because there are a lot of retail investors and institutional investors out there that invest broadly across the MLP asset class, a number of them are very, very familiar with this approach. That also means you're going to end up getting a lot of calls about K-1s, about what they've invested in. The different types of questions that we see are very broad. And so MLPs have to think about what level of support do you provide to your investors outside of the normal touch points that you would typically expect in a corporate structure. One of the other things that is, unique to partnerships specifically is because that income is allocable to all of the partners. It is important to understand that you're going to have a tax footprint that requires potentially reporting, and in some cases, some minor payments across multiple states. So in the MLP context, you're looking not only at what states do you have assets and operations in, but also what states do you have partners in, because those residency partners can trigger specific reporting requirements for the entity itself. So also something to just be conscious about in that regard. So I think the takeaway here is really the structure is a very powerful financing tool, especially as your hydrogen infrastructure assets continue to mature. But you do want to go into it with eyes wide open, preparing for IPO readiness, looking at your public reporting, how that interplays with your investor relations, K-1, state tax mechanics. All of that has got to be built into your readiness plan from a day one launch. And so there's a wide bucket of avenues that we need to look at as you're preparing for that initial drop and primary offering from the market. With kind of that foundation on why the structure can be attractive and what it really takes to run it, I think Mike or Barbara, I'm turning it over to one of you to talk about more specifically on the hydrogen assets, what the opportunities we see out there are right now.
Thanks, Chris. So we talked about the fact that these new qualifying income rules, they will allow hydrogen pipelines, hydrogen storage facilities, hydrogen terminals. Those all fit in an MLP now. So how do you take advantage of that? I mean, if you happen to already be an MLP, then you say, great, I can now acquire those types of assets. I can organically develop those kinds of assets. If you don't have an MLP, then one possibility is to get one. If you've got a lot of those kinds of assets and can do your own IPO, you can form an MLP subsidiary that you own most of the interest in, and that you sell some of to the public, and see how much money you can raise from the public, and continue to drop more assets down into that MLP in exchange for cash raised from the public as you go. If you don't have that kind of scale or patience, there's obviously there's as many possibilities to work with an MLP as you're only limited by your creativities. Obviously, you could an MLP would be a potential buyer of the asset for cash, or you could in a tax-free transaction transfer the assets into the MLP and take back an equity interest in the MLP if that's appealing. Or you can form a JV with an MLP. The MLP, if you form a 50-50 JV, the MLP's share of the income from the JV will be qualifying income to the MLP, so they could be your partner in the ownership of these assets. If you've got a very large asset, I don't know if that's a possibility for assets like this, you could drop it down in slices, do an IPO with a fifth of the facility and then drop in more slices as you go. Again, the only limit is your creativity. So while we're talking about MLP capital, I'll turn it over to Marc to talk about patient capital.
Great. Thanks, Mike. And I think, look, the message here is really, well, geez, we've been listening to, the 4 or 5 of us for the last 51 minutes, and a lot of the business that I'm involved in as a hydrogen operator or somehow we're involved in the hydrogen ecosystem sounds a heck of a lot what I do in terms of providing kind of mission critical infrastructure for energy sources. And so I think that's much of the message that we hope to deliver today, that the infrastructure needs relative to the hydrogen universe are incredibly similar to that of what MLPs up until this expansion of definition have focused on. look, at the end of the day, there maybe are some implications relative to the lightness of hydrogen, two hydrogen atoms versus one carbon, four hydrogen atoms for natural gas, and a whole string of carbon and hydrogen for oil. But that's all solved for via kind of compression and other means. And so the need to store, the need to move, the need to process to get from production to consumption exists across the hydrogen infrastructure, which again is a large part of why the definition was expanded to include the same midstream activities of predecessor energy sources. And so, as you can see here, hydrogen infrastructure require long duration funding for capital intensive assets. Again, there's a lot of upfront investment required in building out facilities and plants and things of that nature, storage facilities, underground caverns, truck infrastructure. Again, that's what the MLP structure really is optimized for, given the capital intensive nature of the industry. The cost of capital advantages that the structure provides is very well suited for that. We talked about the stable contracted revenues that are inherent in the way oil and gas midstream operate. Again, same thing in the hydrogen space, as all of you know. And so the contracted nature of the hydrogen space fits very cleanly and well into the MLP structure. Again, the aspect and the attribute that investors love, that predictable nature of the cash flows that they're investing in. Repeatable expansion capital. And so again, oftentimes infrastructure is expanded. Networks are built upon connectivity considerations. The energy infrastructure network for oil and gas wasn't developed overnight. It wasn't even developed over a decade or two. And so the constant need to return to investors to fund highly accretive projects worked for many, many years. And again, an investor base that values the yield-based nature. And again, as a generator of assets that provide predictable, stable cash flows, your ability to pay distributions to investors is very well appreciated by many in the investor landscape. Again, particularly the retail investor landscape that perhaps may rely on the yield for retirement or even funding their daily lives. And so I think with that, Lori, I was going to turn it to you to maybe field some Q&A.
Sure. Thanks, Marc. Appreciate that. We just have some disclaimers here, and I want to thank our panel. We do have some questions, so I'm hoping one of our experts could expand a little bit on this question. To what degree are MLPs similar to REITs?
I'm happy to
Mike,
talk
do you want
about
to take that?
Sure. Yeah, absolutely. So they sound very similar. They are pretty similar. They sound pretty similar. There's a 90% and a 95% qualifying income requirement for REITs. It's all very real property focused, obviously. And I would say a significant difference is that REIT is really more of a corporation, so a little bit more friendly to foreign investors. And then since it's a corporation, you don't get some of the same kind of pass-through tax type benefit. I mean, the REIT is a pass-through entity, but tax basis step up to a later purchaser of an interest in the entity is not available there. So there's a lot of fun details in the weeds, although they are in some ways pretty similar.
I think one of the big differences too, right, is the REITs have 1099s and the MLPs have the
corporations.
K ones too.
That's why they work for foreign investors.
Yeah.
I think, Lori, maybe one other point. With the REIT, there's distribution requirements. With the MLP, we've talked a lot about they make distributions. They are yield vehicles. There is typically within the MLP a floor of distributions. There's usually a required minimum quarterly distribution. And so I think just to highlight that as something to think about as well. and how you set that minimum distribution to launch your MLP.
If I could add one piece to that, which is, again, because the REITs are required to pay out a majority of their cash flows, again, required to, historically, MLPs have paid out a majority of the cash flows they generate. It used to be 10 years ago that if a MLP generated $115 million of EBITDA, they'd pay out on average 100 of that, keeping that 15 million buffer. Today, the MLP structure basically has 2 times coverage, which means that to pay out 100 million, they're really generating 200 million. And so, again, investor hat, very state. Not only is it a highly yield focused aspect, it's actually significantly backed by even greater cash flows that the companies will use to reinvest in business and infrastructure.
Thank you. I know we're getting really short on time, so just 2 other things. One of the things we didn't really focus on was the fact that now that hydrogen assets are eligible to be MLPs may also be excellent targets for existing MLPs who want to expand into similar businesses. So that's one thing you may want to keep in mind too, that you may be seeing interest from existing MLPs trying to expand their portfolio of businesses, looking at some of your assets. And then if you would like to learn more about MLPs, we have a lot of materials on our EIC website under education. And then also we do have an investor conference May 18 to 20 in Florida. More information can be found on our website under the events tab. And I just want to I want to turn it over back to Frank. I just want to thank Frank and Connor and FCHEA for their partnership in this effort. And we look forward to continue to work closely together on these issues. So thank you so much. And I want to thank our panelists too. Really appreciate your insights and expertise. Frank, thank you.
Well, Lori, I want to thank you, Mark, Michael, Chris, Barbara for contributing your time and the expertise. We're really fortunate to be able to pull this together. Also to all the participants, look forward to other types of these deep dive, specific kind of webinars. We want to try to be a convener of the right information for the industry. And there are also new topics coming up. With that, I'll leave, and I really learned a lot myself. I appreciate all the insight. And for those who want to go to Florida, go to the EIC conference, take a look at it. It's a great event if you really want to deep dive in this. And to everybody who participated, thank you for taking the time. And I'll end with that. So you all have a great rest of your afternoon on the East Coast or West Coast or internationally, and we'll see you next time. Thank you.
Thank you.